Hello everyone, welcome back to the SPAC Arena. Today we're going to be talking about IPOB that's going to be merging with Opendoor. This is Chamath's latest acquisition, and a lot of you have been requesting it in the past few days, so here it is. Now I'll be honest with you guys, I have some mixed feelings about this company. On one hand, I'm kind of skeptical about the business model, it's just not my cup of tea, but at the same time, I do think that it's going to be very successful. So I'm kind of like conflicted about it. We'll talk about all of that. But first, this video is going to be split into 4 parts. First, what's this company about? What's the size of the market? What are some of the risks and the financials? And then how I'm going to be playing this stock. So let's get started now. But of course, as usual, please like and subscribe. It really helps me out and it helps support this channel. Alright guys, just before I get into the review, we've had a lot of new subscribers in the past 2 months, so for those of you that don't know me, I'm Patrick. I've been investing in real estate and the stock market for over 10 years now, and this experience is going to affect my valuation of Opendoor because they're a real estate company that try to do stuff nationwide. So just to let you guys know, I don't claim to be an expert by any means or the authority, but I've managed real estate investments in New York, Virginia, South Carolina, Georgia, Florida, Tennessee, and Missouri. So this is a house that I fixed and flipped in Florida. We made about $22,000 in profit. This is one of my rentals in Memphis. Last year, this tree actually fell, and we actually had to deal with contractors. So just to let you guys know, this experience is going to affect my valuation of the company. You guys need to do your own due diligence. You have your own experience. So when it comes to investing, a lot of your analysis is going to be subjective based on your past, right? So I just wanted to let you guys know ahead of time. And now let's get on to the actual review. So enough about me, let's get into the review itself. What does Opendoor do? Well, it's a company that presents itself as doing two main things. The first one is buying and selling real estate like a home flipper would do, right? So they'll give you an offer on your house, pay cheaper than market, do some repairs on it, and then sell it at a profit. So you have it here in the investor presentation, receive an offer, online cash offer, flexible close date, all of that good stuff. But see how they emphasize a lot their app and how they're a digital platform, because that's how they're selling it to their investors. They're making it digital, right? And you'll see it here too. The second component of their business is helping connect buyers and sellers, kind of like a normal traditional brokerage. So unlock home ownership for millions of Americans, buy, sell, and move at the tap of a button. Again, look at how they really put a lot of emphasis on their app, because that's how they're going to get a big premium and multiplier for their company when they go to Wall Street. So if you go on their website and you want to sell your house, you'll have two options. The first one is to sell it right to them, right? They'll give you a cash offer option, and then the other option is the traditional one, like any other real estate brokerage, where they'll list your house for you and they'll charge you a 5% commission fee, as opposed to the traditional 6% with a real estate agent. Now, if you're looking to buy a house and you go on their website, well, now I clicked on Orlando just to check like their inventory. Right now, they have about half a dozen houses for sale. So they would add your house to their website, kind of like you'd see it on Zillow. So when you click on one of the houses, you'll end up on this screen, which shows you all of the stats for the house plus pictures. But more importantly for us, you'll see this buying button. And now when you click on it, select a buying option, you'll see get introduced to a top local agent. Work directly with a top agent who can help you buy any home, Opendoor or not. Does this remind you guys of a website like Zillow or Trulia, where they have real estate agents pay to be on the website and get leads that way? So this is where I'm getting at with this, is that this company, yeah, they're advertising that they'll be connecting buyers and sellers, and they're advertising that they'll be buying and selling houses like as an investor. But my feeling with this company is that they're going to be monetizing it in 10 different ways. They're going to be selling leads. They're going to be making money with other services that I'll talk about in a minute. If you look at the management for the company, you'll see that these aren't like small entrepreneurs that started in their garage. No, these are all insiders in the real estate industry, mostly Wall Street and the tech industry in California. So you have Eric Wu, worked at Trulia, Amazon, Airbnb, this guy Netflix, Lyft, Uber, Expedia, Airbnb. all of these massive tech companies that have crazy valuations and have raised billions and billions of dollars. And this is the feeling that I get from this company. This is a very corporate company. So this is going to be very relevant later on when I talk about what's going to happen with this stock. So how big is this company and what's the size of the market? Well, right now they're in 21 metro areas, mostly in the Southeast, the West, and Texas. But of course, over time, they want to expand nationwide in all of the primary and secondary markets. And this is where I'm getting a little bit more skeptical because everyone that's been investing in real estate, I know you guys probably have too, or you know someone that has rentals or something like that. You all know how difficult it is to deal with contractors. They're just not reliable. So as I mentioned, I've dealt with contractors and subcontractors in several states, and they just never do their job. Like never. So I'll give you an example. This is the tree I was telling you guys about. This is why I was showing you that house, right? This tree fell, and then it took months and months and months to take care of it. Why? Because they told us that they did the job. They showed us fake pictures, right? And then this is what the yard looked like. They just left a big hole. And worse than that, they just left the entire thing next to the road until a few months later we got a citation from the city and the tenant eventually called. Well, this is one house. Imagine dealing with hundreds and hundreds of contractors in cities across the country and dealing with thousands of projects. So, can they do it? Of course, it's possible. But from everything I've read, the reviews of Opendoor rehabs are very average, right? People aren't excited about their rehab jobs. But let's give them the benefit of the doubt, right? This is my anecdote. I know you guys have the same type of experience, but we'll give them the benefit of the doubt. How have they been doing so far? Well, in their 21 markets, they say that they served 80,000 homeowners, and their revenues have grown significantly over the past few years. Now, keep in mind, again, this is an accounting trick. I'll tell you in a second. But in 2017, they were at 700 million, 1.8 billion rather, sorry, in 2018, and 4.7 billion in 2019. So 18,799 homes sold in 2019. So those are great numbers. Just remember one thing here: revenue. This isn't remotely close to profits. The profit margin in fix and flips is very small. The way that they do it is, let's say that they buy a house for 200,000, right, and they sell it for $250,000. Well, they're not going to list it as $50,000 in revenue. They're going to be listing it at $250,000 in revenue and 200,000 in expenses. So these numbers, of course, they're great, right? They're growing rapidly, but you can't assume that there's a lot of profits in there. This is just because they're doing more business and they're selling in large quantities, but that doesn't equate to profits necessarily. So as you guys can tell, I'm not that thrilled with the entire fix and flip part of their business. I just don't think that they're going to make a fortune out of it. This isn't a business I would be investing in at all personally. Now, here's where it gets more interesting. This is where the money is going to be. Consumers demand digital experience for the services that revolve around the home. They're going to package a lot of other additional services with these transactions, and this is where they're going to be making all of their money. They're going to be making money with title and escrow, financing, insurance, warranty, upgrades, home maintenance. These are all services that they're going to connect, right, with their platform and they'll benefit from. I want you guys to imagine, how like Credit Karma, when you go there, they're not making money with telling you what your credit score is. They're making money with telling you about credit cards, right? They get paid by the credit card companies. Well, imagine the same type of thing here. They're not going to be making a lot of money from fixing and flipping homes. What they're going to be making money with is all the additional servicing, the financing for the houses, the title and escrow, the insurance that they'll sell you, all of those connected services. Even Chamath, I love this guy. I had to leave the picture here. Look at how happy he looks. So Chamath mentioned it in one of his one-page paper, right? This is a crucial part. As they buy and sell more homes, they have the opportunity to attach other value-added services. They have already launched title and escrow and financing services and have plans for many others in the future, including home upgrades, maintenance, and warranty services, which we expect will increase contribution margin and profits over time. So current value-added title and escrow services attach at 80% by number of transactions. So you guys see the point here? This is exactly what I was telling you about. They're not going to be making money necessarily with the business itself. They're going to be making money with all of the connected services that they're going to be attaching to it. All right, so now let's look at the revenues and the unit economics to see how this company actually plans on making money. Right now, they're not doing that great yet. It's the ramp up period. They have a lot of fixed costs and they're just not that profitable. So this is for their Phoenix market, which is one of their better ones. First quarter margin performance 7.3%. Then of course they have selling expenses. So the gross margin is 4%, and then after interest, because they borrow to buy these homes, they're at $8,000 per house, which is about 3%. That's not great, and this is in one of their best markets. If you look at their entire portfolio, they're at 3.1% margin and then 1.9% after interest. So this is not good, right? This is where they'll be losing money for a while at these rates. If you look at this chart, you can kind of see what I was talking about. Right now, these are their better markets that they're actually positive with their margin, and then some of the underpenetrated markets they're going to be losing money because they have a lot of fixed costs, they're ramping up, right? All of those costs add up and take away from their profits. So right now the company is losing money. If you look at this chart though, this is the end goal, right? Is to package all of these added services, and this is what they're planning on. This is for the title and escrow, right? When they launch a service, I hope you guys can see it. It was at 5.7%, right? Of all the transactions, they only added to 5.7%. But as they push it more and more with their clients, now they're at 82.9%. So if you look at the breakdown, title and escrow, they think that they can do about $1.7 thousand per home. And then the other services that they're adding, which they'll try to increase the percentage, right? You have the home loans, 5,000. The buy with Opendoor, I guess that's their brokerage, right? That would be 5,000. List with Opendoor, that would be them selling your house, 3,750. And then those are some of the other services that they're planning on adding in the future. You have the home warranty, the remodel services, home insurance, and then moving. That would account for about 7,500 in their revenues. So this is what kind of looks like. They have huge growth right now. I mean, even though I'm not a huge fan, as I mentioned before, of the fix and flip, right? You still have to give them credit for the big growth that they have. They went from 3,127 houses sold in 2017 all the way up to 18,799 in 2019. And then in the first quarter, they mentioned that they already have 19,632 sold, which is a massive compound annual growth rate of 145%. And you guys know that Wall Street is just going to gobble that up. They're going to love this. Revenues up 159%. 700 million first year, 1.8 billion, 4.7 billion, and then they mentioned 5 billion in the first quarter. So adjusted EBITDA, again, this is the profit rating, profit margin. They were very negative in the beginning in 2017, and now as the years go by, they're still losing money, but they're losing less money. All right, we're almost ready to wrap up, but now that I'm looking at the financial projections, I noticed I made a small mistake. So here in this slide, when I said 19,000 houses sold and 5 billion in revenues, that would have been their projections without the pandemic. With the pandemic, their business took a big hit. Homes sold down 49% for this year projected, and revenues down 48% projected. So they took a step back this year. And maybe that's why Chamath was able to lock them in, is because the company is losing money. They needed a cash infusion, and the SPAC is probably going to be saving them. So they're not going to get to the 2019 levels until 2022, when their revenues are going to grow again to 6.2 billion. If we look at the EBITDA, right, down 141 million this year, 185 next year, 123 in 2022. And then by 2023, they think that they can squeeze by a tiny $9 million profit. So we'll have to see. Now, the company is underwritten at $4.7 billion, right? But that, again, that's at the IPO price of $10. What you want to do is you want to replace this number by the IPOB share price, which right now is at 1460. So let's just do times 50%. You guys can calculate it yourself because obviously it's going to change every day as the IPOB share price changes. But let's say that right now it's at about $7 billion valuation. Now, is this overvalued or undervalued? Well, as I mentioned before, this company is totally engineered 100% by Wall Street for Wall Street. They have all the criteria to give it a massive valuation. Notice how they gave all the characteristics of their digital platform, and they have an app, right? And they're transforming the game, and they're adding all of these services. Well, they want this massive valuation. And if we look at some of their competitors, which don't do necessarily exactly the same but close, we have Zillow, right? Company that's losing money every year for the past years, and they have a valuation of $21 billion. If we look at the past 6 months, look at how much it's increased. I mean, it almost tripled. If we look at Redfin, another company in the same space, kind of, right? Operating income negative every year, pre-tax income negative every year. Like they're just losing money every year. And then when we look at their valuation, we'll see 4.9 billion. This one is actually trending up too, right? So all of these companies are designed to extract a lot of value and get a lot of institutional investors that are just willing to pay a premium because it's considered a tech stock, even if it's a real estate company. So in the close, the big question is, what do I think about this stock and how am I going to be playing it? Well, you guys can probably tell from the review that I have mixed feelings about the company. I'm very skeptical that they'll be able to expand nationwide and still be profitable when it comes to the fix and flip business. Now, when it comes to brokerage and actually selling additional services, I do think that they'll be successful with that. But, it's just not my cup of tea. It's not the type of thing I'm passionate about. So personally, I'm not really attached to this business model and this company. Now, with that said, that doesn't mean that the company is not going to be profitable for us as investors. That's what's most important. We're here to make money. It doesn't matter if I like the company or not. All that matters is, are we going to make money with it? And when you look at valuations for companies like Zillow at $21 billion, a company that's been losing money for years, I mean, this company might be a steal at $7 billion. I'm not going to pay this much, right? I'm not going to buy it at 1460. But it is very, very possible that because the company is engineered to extract all of that institutional money, it's very possible that it's going to go up to crazy valuations over time. You saw the progression of Zillow this year, it almost tripled. It's very possible that the same thing happens with this company over time. You saw the Snowflake IPO, right? Companies just want to dump all of their money into these tech stocks. So that's why this company is engineering everything. Like their entire marketing is talking about their digital platform and their app and all of that stuff. So at 1460, right, to me it's too expensive. If it does go down to $11, $12, even if it goes under $11, like we've seen that happen before, then I might be interested in picking up some shares just to have a little bit of exposure. As I mentioned, it is very possible that Wall Street is going to bid this stock up. But at 1460, it's too expensive for me. And then you have the warrants at 477. Same for me, again, too expensive for me. But you guys have to figure out, if you plan on holding this stock for 5 years, the warrants might be a great deal for you. 1460, I'll wait until it goes a little lower and then I might buy some shares. But for me, it's not one of my big stocks that I plan on invest a lot of my money into. So I hope you guys enjoyed this video and this review. Maybe it gives you some ideas for this investment. Tell me what you think of the description. In the comments rather. Do you guys think that this company is overvalued, undervalued? Do you agree with me that because it's considered like a tech stock, it's going to explode in price and have crazy valuations? Just let me know what you guys are going to do. We'll talk about it and discuss it, and I'll see you guys in the next video. Thank you for watching.